What if the biggest lie about retirement isn't how much you need, but how long it takes? Most people believe stopping work requires 40 years of grinding, saving, and hoping nothing goes wrong. But the truth is far more uncomfortable and far more hopeful. Because the reason most people never retire early has nothing to do with intelligence, income, or luck. It comes down to where they quit and when. Right before the math flips in their favor. In fact, if you follow a simple monthly framework, retiring in 10 to 15 years becomes mathematically realistic for ordinary people. But miss 2 specific steps and the entire plan quietly collapses, no matter how hard you work or save. So the real question isn't, can I retire early? It's why most people fail just before it becomes inevitable, and what the numbers actually reveal once you see the full picture. Most people don't fail at retirement because they're careless. They fail because the process lies to them in the beginning. Here's the pattern almost everyone follows. You earn money. Most of it goes to bills and daily life. You save a little. You invest a little. Month after month, you do the right things. Then, you check your account, and almost nothing seems to change. That's the invisible trap. Early progress in investing feels painfully slow, almost insulting. It creates the illusion that nothing is working even when everything is. And that's exactly when most people stop. Not because investing failed, but because patience did. In the early years, compounding is like pushing a heavy snowball uphill. It's awkward, exhausting, and unrewarding. Every push feels pointless. But if you keep going, something critical happens. The snowball reaches the peak, and gravity takes over. From that moment on, momentum does the work for you. That's why so many people never reach retirement. They quit in the hardest phase, right before the math starts working in their favor. And when you zoom out, instead of focusing on short-term progress, the numbers tell a completely different story. There's a simple piece of math that explains exactly when this shift happens. And once you understand it, you'll never look at slow progress the same way again. If progress feels invisible in the beginning, how do we know compounding is actually doing anything at all? There's a simple piece of math that answers that question. And once you see it, it permanently changes how you think about time and money. It's called the rule of 72. Here's how it works. Take the number 72 and divide it by your average annual return. The result tells you roughly how many years it takes for your money to double. At a 10% return, your money doubles about every 7 years. That sounds slow, until you actually follow the curve. Start with $50,000. 7 years later, it becomes $100,000. Another 7 years, $200,000. Then $400,000. Then $800,000. And before most people expect it, you're past $1.6 million. Nothing magical happened. Same money, same habits, same person. The only thing that changed was time. Here's the part most people never realize. The growth doesn't move in a straight line. It bends. Hard. And that bend happens later, not earlier. Which means the first 5 to 10 years are supposed to feel slow. That's not failure. That's the setup. And this is exactly where most people give up. They quit in years 5 through 10, when the line still looks flat. Right before compounding turns from effort into momentum. Now, you might be thinking, that's great, but I don't want to wait 25 or 30 years for freedom. And you're right, nobody does. The good news is, there is a way to compress that timeline dramatically. But before you can speed things up, you have to avoid the most common mistake people make when they start this journey. By now, it's clear that compounding works. Given enough time, the math is undeniable. But here's the uncomfortable truth most people don't want to hear. You can't retire early by saving alone. This is where a lot of well-intentioned plans quietly fail. People focus obsessively on cutting expenses, skipping coffee, clipping coupons, squeezing every dollar, believing that discipline alone will get them to freedom. Let's look at what the numbers actually say. If you save about $400 a month and earn a long-term return in the high single digits, after 10 years, you're sitting somewhere in the $70,000 range. That's real progress, but it's nowhere near financial independence. Now compare that to someone earning more, say $10,000 a month, who saves just 10% of their income. That's $1,000 invested every month. Over the same 10 years, that person ends up with roughly 3 times as much, even with similar returns. Same decade, completely different outcome. This is the key shift most people miss. Wealth doesn't come from extreme frugality. It comes from pairing offense and defense, growing income while keeping spending under control. Because lifestyle creep is subtle, as income rises, spending quietly follows, and progress stays flat. But when you hold lifestyle steady, while income grows, every new dollar becomes an employee working for your future. You can spend that dollar today on temporary comfort, or send it to work so it buys you permanent freedom tomorrow. But even if you're saving the right way and investing consistently, one big question still remains. Where should that money actually go so it grows without putting everything at risk? Once you're saving consistently and investing with intention, the next question becomes unavoidable. Where should the money actually go? Because leaving it in cash guarantees one outcome: inflation slowly erases its value, and putting everything into one risky bet creates another problem. A single downturn can wipe out years of progress. The solution isn't guessing or chasing trends. It's structure. Think of your portfolio like building a house. A strong house isn't one material stacked higher and higher. It's layers working together. The foundation is growth assets. This includes things like broad stock exposure and index-based investments. This layer exists for one reason: long-term multiplication. Without growth, your money never outruns inflation, and retirement becomes a moving target. The second layer is income producers. These are assets designed to generate cash flow, whether through dividends, interest, or rental income. This layer gives you flexibility. It reduces the pressure to sell investments just to pay for life, especially during market downturns. The top layer is stability and protection. This might include bonds, cash reserves, or other stabilizing assets. This layer isn't about getting rich. It's about preventing mistakes. When markets fall, this buffer keeps you calm. And calm investors don't panic sell at the worst possible time. Now, this doesn't mean everyone needs the same mix. Some people lean heavier toward growth. Others prefer more income or stability. Risk tolerance, goals, and time horizon all matter. The real point is simple. If one of these layers is missing, the entire structure becomes fragile. And fragile portfolios don't survive long enough for compounding to do its job. But even with a perfectly balanced portfolio, there's a quiet force working against you every single year. And if you ignore it, your retirement plan slowly loses power, even if everything else looks right. Even with a well-built portfolio, there's one silent force constantly working against you: inflation. It doesn't announce itself. It doesn't crash your account overnight. It just quietly reduces what your money can buy, year after year. And over decades, that erosion can turn what looks like enough into something dangerously short. Here's why this matters. If you stop contributing too early, inflation keeps moving forward while your progress stands still. Today's comfortable lifestyle can slowly become tomorrow's financial stress. The simplest defense isn't complicated. It's consistency with adjustment. Most people make the mistake of contributing a flat amount forever. But there's a far more effective approach. Increase your contributions slightly each year, even by just a few percent. It sounds insignificant, but over time, it becomes a powerful multiplier. For example, if you're investing $1,000 a month this year, nudging that amount up the following year feels barely noticeable. It's often less than the cost of a single night out, but over decades, that small habit dramatically changes the outcome. The same rule applies after retirement. You don't stop planting once the orchard starts producing fruit. Reinvesting a portion of your passive income, even a modest amount, helps ensure your money keeps growing instead of slowly shrinking. This is how retirement becomes permanent, not fragile. The people who follow this approach aren't necessarily more aggressive or smarter. They're just patient and consistent enough to let time work in their favor. But there's another mistake that quietly derails people even when they're doing everything else right. It has nothing to do with saving, investing, or inflation, and everything to do with how progress is measured. One of the most damaging mistakes people make on the path to early retirement isn't quitting outright. It's looking at the wrong scoreboard. Most people judge progress by their account balance. They see numbers like $50,000 or $100,000 and immediately think, that's nowhere near enough. I'm failing. And that single thought is often what pushes them to stop. But balance alone doesn't tell the real story. There's a far more useful way to measure progress, by freedom units. Instead of asking, how much do I have? Ask, how much of my life is already paid for? If your lifestyle costs $5,000 a month and your investments generate $500 a month, you're already 10% financially independent. That's not abstract math. That's real freedom. It's the equivalent of permanently buying back half a workday every single week. And those freedom units stack faster than most people realize. As contributions rise and compounding accelerates, each additional dollar buys you more time, not just more money. This mental shift changes everything. It turns discouragement into momentum. Instead of feeling far away, you start seeing tangible progress with every step forward. And once you view progress this way, a bigger question naturally follows, one that determines how long this journey actually takes. If you've been wondering whether early retirement truly requires 25 or 30 years, the answer comes down to one number. A single calculation that quietly defines the finish line and reveals how close you might already be. If there's one question that quietly determines how long your working life lasts, it's this. How much money do you actually need to retire? Most people never get a clear answer. They just assume the number is enormous, so large it feels unreachable. But there's a simple framework that cuts through the confusion. It's often called the 25 times rule. Here's how it works. Take your annual living expenses and multiply that number by 25. The result is your target, the amount your investments need to support your lifestyle long term. Why 25? Because at roughly a 4% withdrawal rate, that portfolio can theoretically cover your expenses year after year without running out. So if you spend $60,000 a year, your number lands around $1.5 million. If you want a wider margin of safety, especially for early retirement, using a slightly lower withdrawal rate pushes that number higher. But the principle stays the same. Your goal isn't some abstract pile of money. It's a number tied directly to your life. Here's the part that changes everything. You don't need to save that full amount yourself. Compounding does most of the heavy lifting. Your role is to consistently feed the system, month after month, year after year, long enough for time to take over. This is why retirement doesn't automatically take 30 years. When income rises, lifestyle creep stays controlled, and contributions increase over time. The timeline compresses dramatically. Many people reach financial independence in 10 to 15 years, not because they got lucky, but because they understood this formula early, which leads to the real accelerator in the entire plan, the factor that can cut decades off your timeline or quietly keep you stuck forever if you ignore it. If there's one truth that separates slow progress from fast freedom, it's this. You can't budget your way into wealth. Cutting expenses helps at the beginning, but it has a ceiling. Income doesn't. And that's why income is the single most powerful accelerator in the entire plan. Think about the difference. If you earn $50,000 a year and save 20%, you're investing $10,000 annually. That's solid, but slow. Now, imagine earning 3 times that while keeping the same lifestyle. The discipline stays the same, but the results compound dramatically faster. This is where most people get stuck. They focus exclusively on controlling spending while ignoring the lever that actually changes the timeline. Earning power. Higher income means more fuel for compounding. The math doesn't change, but the speed does. The rule of 72 still applies. It just doubles a much larger base. This is why high-value skills matter. Skills that scale, whether in technology, business, design, finance, or creative fields, don't just add a little extra income. They fundamentally shift what's possible. The key isn't living like a monk forever. It's growing income while keeping lifestyle creep in check. That combination allows people to reach financial independence in a fraction of the time most expect. And to prove this isn't just theory, let's look at two people starting from the same place. Same income, same discipline, same market conditions. Yet they end up in completely different financial positions, for one reason only. To understand how powerful income really is, let's make this concrete with two real-world style scenarios. Meet Sarah. She earns $70,000 a year. She's disciplined, consistent, and does almost everything right. She saves about 20% of her income, roughly $14,000 a year, and invests it steadily. Over time, with a reasonable long-term return, that consistency adds up. After 20 years, she's built a portfolio, just over $500,000. That's real progress. But it still falls short of full financial independence. Now meet David. He starts in the exact same place, same $70,000 income, same discipline, same habits. The difference is that over time, David invests in his skills and gradually increases his earning power. Eventually, his income rises significantly, but here's the key. His lifestyle doesn't rise with it. Instead of upgrading everything, he keeps living roughly the same way and redirects the difference into investments. Now he's contributing closer to $30,000 a year. Fast forward 20 years. David isn't sitting on $500,000. He's closer to $1.3 million. Same market, same consistency, same time horizon. The only real difference was income power. That single factor didn't just help a little. It cut the timeline to financial independence nearly in half. This is why income is the true multiplier. It doesn't just grow wealth. It buys back years of your life. And once you understand this, everything comes together. Saving, investing, adjusting for inflation, and increasing income aren't separate ideas. They're parts of one system. When they work together, the outcome becomes almost unavoidable. Which brings us to the final truth of this plan. The reason early retirement isn't about luck, timing, or perfection, but about staying consistent long enough for the math to take over. When you zoom out and look at the entire picture, one thing becomes clear. Early retirement isn't a hack. It isn't a secret strategy reserved for a few lucky people. And it definitely isn't about timing the market perfectly. It's about staying in the game long enough. When you consistently save, invest with structure, adjust for inflation, and grow your income while controlling lifestyle creep, compounding quietly takes over. At that point, the process becomes less about effort and more about patience. This is why people who follow these principles often say the same thing in hindsight. The hardest part wasn't the math. It was not quitting early, because once the system is fed consistently, it becomes surprisingly resilient. Market swings matter less, short-term setbacks lose their power, and progress, which once felt invisible, starts accelerating on its own. That's the real plan for early retirement. Not extreme sacrifice, not unrealistic promises, just understanding how the system works and letting time do what it's always done best. And if you're earlier in this journey than you thought, that's not bad news. It's leverage, because the earlier you stay consistent, the less heroic your effort has to be later. The question isn't whether this works. The question is whether you'll stay long enough for the numbers to work for you.